Yes, hello and welcome to the Business of Property podcast. I'm Stuart.
And I'm Simon.
We've been finding, buying and growing income from property for over 20 years, and we talk every week about the reality of running our property businesses. Don't forget, please do leave us a rating on your podcast player. Really does help us, and just lets us know, A, that you care, and B, that you're enjoying the show. So please do that. It really helps. Today, we are talking about Simon's property business. So if ever you want to see Simon look really uncomfortable, this is the episode to watch on YouTube, because this isn't something Simon enjoys. And I've been given carte blanche, I believe, to ask questions about, about Simon's property business and property revenues, because we did a bit of a breakdown on mine a couple of episodes ago. So we're going to do this with Simon's as well. And Simon's property business is different, slightly different to mine in that it's
very different, I think we can say.
It's very different to mine in that it's a buy-to-let portfolio as opposed to an HMO portfolio, and so has a different makeup. But let's start with the same place, really. So let's start with revenue, Simon. So we when we ran through my business, we're talking about how the revenues had grown. So let's pick a starting point. So for your business, we've got a number of tax years. Let's start back in the heady days of 2016 to 2017. What did your property business portfolio look like?
So back then, it was 3 properties. So 3 houses, buy-to-let, rented families, simple, run-of-the-mill as you can get, really. And it was, in that tax year, it generated revenue. So this is not profit or anything. This is just raw revenue of about 36,000. And then you could take off that. And remember, this is back in the day of very low mortgage rates. And these properties were all mortgaged. There's no full ownership of any of these properties, but the total expenses that year, including mortgages and other bits and pieces, were only 7,000.
So this is a profit, if you like. Before, this is what we'd probably call. So this is pre-tax.
This is all pre-tax that we're talking about.
Right, so this is what we'd call in business. This would be your EBITDA, your earnings before interest, tax, depreciation, and amortization of 29,000. So I think that's a pretty good business. That is close to an average UK salary. So this is good. And the interesting thing for me, and one of the reasons why we've kind of started in 2016, is because something came into play from 2016, which screwed a lot of people. I'm not mincing my words on this one today, but it screwed a lot of people, which was Section 24. Simon, as this is your pain, let's remind the listeners and the viewers what Section 24 is.
Yeah, so this is all a personally owned property portfolio. So it's owned in personal names rather than limited company. And that is specifically what Section 24 affected. So it meant prior to I think the 2016, 2017 tax year was the last year this was the case. And in that year before Section 24 had real effect, it meant that all of your mortgage expense was counted as an expense against tax. So the profit calculation that you pay tax on was taken after deducting all of the mortgage expense. Roll on 5 years later, when Section 24 was in full effect, and you could no longer count any of your mortgage interest payments as expenses. So when you were calculating your profit, you had to effectively sort of add back in the mortgage costs or not deduct them in the first place. And it was that total that your tax was then calculated on. Now, there is a 20% tax credit against your finance expenses. There are some extra requirements or things you must meet in order for that to work. So we're not going to go into all the details now. but in most cases that does work. So if you're only a basic rate tax rate payer of 20%, then it effectively works out about the same. But if you're a higher rate taxpayer, then you only get 20% allowance on the finance cost rather than it being a full allowable expense.
So instead of avoiding the pain, we're going to go straight into it now. So 16-17, you had a profit of 29,000, as I say, very good. 17-18, Simon, what was the profit that year?
So this was an interesting year because it was a sort of, well, it was a year when I was purchasing. So
He's trying to avoid giving us the number. I'm just letting you know.
I don't know what you mean. So the revenues went up a bit. They were 42. However, I had a lot of expense this year as well, and they were 38,000. So the profit was quite small at about £4,000.
So that's a significant drop. So the revenue increased by 6,000, but the profit dropped by 25,000. However, your mitigating circumstances are whether you were taking on a new rental property. Is that right?
Yeah. So this was an anomalous year because there was a new property coming on. So obviously, lots of the costs, if you were taking on a new property and sort of completely refurbishing it and whatever else, you can't count as immediate expenses. They would be capital expenses. They would come off when you calculated capital gains when you sold the property. But this property wasn't in that state. It was actually taken on with existing tenants, so it was all serviceable as a rental property. And it was only when those tenants actually left a few months later that I then did a refurbishment and repairs and things. So it all counted as sort of normal rental business expenses. So yeah, there was a lot of expense in that year.
And after that year, I mean, essentially the revenue then went up again. So you went from 2017-18 up to 42,000, which was a 6,000 increase. And then we assume because of the onboarded property, that revenue then went up again to 54,000.
Yep, indeed. And now we're back down to sort of more standard level of expense as well. Only £20,000 of expense. Ooh.
Well, it's still triple, and that's the interesting thing when we look at your revenues and costs over the years, and that's the thing. So, yeah, the income has jumped up to 54,000. But when you say the costs have gone down, but they've gone down to 20,000, so basically triple what they were 2 years prior.
Yep, and this is just due to assorted things happening in the business in this year. So I can't really attribute this to anything very specific. In a few years' time, as we keep going, then there were new mortgage rates coming through and things changing a lot there. But on this one, there was just bits and pieces.
Yeah, and then essentially for the next few years, I would say that the revenue has stayed pretty much not static. It's basically remained around sort of 55 to 60k, and
Yep.
profits have also. I mean, 1920, you'd got up to 39,000 profit, which is very good. And talk us through the year, because we know that you took on another property, but actually you took that on a limited company, so that hasn't impacted your personal properties at all.
Yeah, indeed. So a couple of years ago, I purchased my most recent property, but I purchased that in a limited company rather than in a sort of personal name portfolio. So we've not included that at all today, just to keep things simple, because otherwise you have to sort of worry about corporation tax and then working out what's withdrawn and what's income to me versus income to the company, and it's just too complicated. So we have recorded another episode, which I should have looked up the number for, but it will be in the show notes. And we delved into the income and the expenses and indeed the profit that are within that limited company specifically for that new property. But we're not covering that today. So this is just personal name properties to keep things simple.
So 21-22, we were looking really. We had a revenue of 60,000, and actually a profit of 43,000. So that is now really good. But talk us through the year after, because things dropped a little bit in terms of income, but a lot in terms of profit.
Yeah, so because this is personal name properties and because we're looking at it on a tax year basis, and it means that things can sort of fluctuate a little bit more than they really look like they are. Specifically, the tax return is prepared, or the figures for tax return are returned on a cash accounting basis. So occasionally a tenant will pay rent a bit late or a bit early, maybe, depending on situations and things. And that will just sort of push payments into a different tax year than they would normally be in. So these fluctuations, so for 1920, we're looking at revenue of 56,000, 2021, 55,000, 2022, 60,000. Then 2023, the revenue dropped back down to 58,000. And these little fluctuations are all around just the effects of when tenants pay different amounts. There was also a little bit of reduction in the 2021 figures because of COVID, and I let tenants off a little bit of rent for sort of COVID effects. And there was also in various places little bits of void and things and tenant changes and stuff like that. So it 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 does sort of go up and down, but mostly it's just because of these sort of other factors. I haven't really changed the portfolio's income as a whole over these few years.
The little fluctuation I'm quite interested in is the one of for 21-22 of 17,000 costs to 28,000 costs the following year.
Yeah, well, that's the joy of new mortgage rates.
Because if my accountant called that a little fluctuation, he would be getting a book up to the side of his head.
Yeah, quite. I mean, and yeah, I mean, a jump of that much in mortgage costs it was really painful, especially when you've got Section 24 as well, meaning that they can't be fully counted as an actual expense. And it's painful. And I've got another remortgage coming up later this year as well. So the pain is only going to get worse. And yeah, I went from mortgage rates of 1.5% kind of level to 3 to 4% kind of level over the course of I thought it was over the course of a couple of years, but actually, as we've looked into these figures, I think actually most of it might have happened in a single tax year, and yeah, it's painful, very very painful.
And I think it does highlight because, overall, in summary, you've kind of added on 20 odd £1,000 of revenue, but because of Section 24, not wishing to rub it in, you've added on. You've also got £20,000 of cost that's come onto it. So as we talk about in the title, it's this revenue has come at significant cost, quite literally. And as a listener or as a viewer, you might be thinking, but why? So why on earth would you do any of that? You wouldn't. It's basically you're putting in a lot of effort to stand still. But what have you benefited from by doing these things?
Yeah, exactly. When you look at the raw figures, my revenue going up nicely, well, fairly in long term view, but because of mortgage costs going up, my expenses have gone up a lot. And then because of Section 24, that's had an outsized impact on my actual profit levels as well. So basically, I'm making the same amount of money now as I was, I don't know, in the region of 10 years ago. It's yes, seemingly pointless, as you say. But the silver lining to all this is, of course, capital gains. And we don't have sort of actual figures. We couldn't easily put together valuations for specifically when we started this sort of summary of figures. But we do know that I've seen in the region of 50%, maybe even 60% increase in value of my property portfolio versus the purchase price to the current value today. And that's these are properties in the southeast, so they're not cheap properties, and that's a significant amount of money that is absolutely not in my bank account, unfortunately, but it is sitting there in property value, ready to be utilised at some point one day.
Yeah, and in terms of equity, the equity amount is pretty good based on your portfolio size because it's seven figure, and what's your rough loan to value on that percentage wise?
It's somewhere 55 to 60%, something in that region, loan to value currently. So yeah, if it was higher, my mortgage cost would be even scarier. So I'm very pleased that a lot of these properties have been owned for now, well, the first couple of them 20 odd years now. So that has helped a lot, I think. Just that elapsing of time, allowing for the increase in value in the property and the not so rapidly increasing value in the mortgage.
And let's finish with some good news. I mean, that is good news. And the other good news is that, that you're forecasting roughly for 23-24 year, around £37,000 of net income, which, so if you go back to several years ago, it's £8,000 more. So, it's still a significant increase, a lot of effort, a lot of time, but it has grown.
Yeah, it definitely has grown, and it is good. It's not necessarily as good as it would be. Well, it's definitely not as good as it would be if the mortgage rates were lower. And the slightly depressing thing is that after tax, the revenue is still actually not going to be any better than sort of 5 years ago or so. But yes, it is overall good news. It is a good portfolio. It is building over time gradually, and the capital gains value is definitely building over time as well, and will be a good pension pot effectively, which is what these investment properties always were for me.
And there you go, dear listener and dear viewer, that is the long-term strategy, and Simon's demonstrated that very well. I think warts and all, because we like to present the business of property as it is, not as we'd like it to be. But there is income to be had, there's capital appreciation to be had, but it's not without effort, and it's not without a lot of blood, sweat, and tears. And in my case, I've definitely had all of those things to build a portfolio. But hopefully that gives you an insight as well to Simon's approach and Simon's income. And if anyone's got any questions on it's Simon's or mine portfolios that we've talked through, please do reach out to us, and you can just look in the show notes of ways to contact us and reach out to us there, and we'll respond as quickly as we can. Other than that, hope you've enjoyed the show. If you have and you've listened this far, please do leave us a rating at least. Other than that, we'll see you on the next episode.